The 1970s, an era of bell-bottoms, disco, and a profound economic crisis that forever changed the meaning of money. For many, it was a decade of financial ruin. Prices skyrocketed, hard-earned savings evaporated, and the very foundation of the American dream seemed to be crumbling. The dollar, once a symbol of stability, became a source of anxiety. Those who placed their faith in paper currency watched their wealth disappear. But for a select few, this chaos was not a catastrophe. It was the opportunity of a lifetime. Those who understood the enduring value of real assets didn't just survive, they became legends. This is the story of how money lost its meaning and how fortunes were made and lost in the ensuing storm. It all began on a quiet Sunday evening, August 15, 1971. In a televised address to the nation, President Richard Nixon delivered a speech that would sever the last link between the US dollar and gold. He announced the temporary suspension of the dollar's convertibility into gold. This decision, known as the Nixon shock, effectively ended the Bretton Woods system, which had governed international finance since the end of World War II. For decades, the dollar had been anchored to gold at a fixed rate of $35 per ounce. This anchor provided a tangible backing for the currency, limiting the amount of money the government could print. With that anchor gone, the dollar became a fiat currency, its value based solely on faith and trust in the government that issued it. The floodgates were opened. With no physical constraints, the money supply could now expand at the whim of policymakers, and expand it did. The government began printing money at an unprecedented rate to finance social programs and the ongoing war in Vietnam. This set the stage for a slow, insidious erosion of purchasing power. Inflation, once a distant economic concept, began its relentless march through every home, every business, and every wallet in America. The quiet march of inflation turned into a deafening stampede in October 1973. In response to U.S. support for Israel during the Yom Kippur War, the Organization of Arab Petroleum Exporting Countries, or OAPEC, declared an oil embargo against the United States and other Western nations. The effect was immediate and devastating. The price of oil quadrupled almost overnight. The lifeblood of the industrial world was suddenly scarce and expensive. The crisis manifested in long, snaking lines at gas stations where frustrated drivers waited for hours to fill their tanks. No gas signs became a common sight. The energy shortage sent shockwaves through the entire economy. Factories scaled back production, leading to layoffs. The cost of transporting goods soared, pushing up the price of everything on store shelves. From a loaf of bread to a new car, the cost of living exploded. The public's frustration boiled over into anger and a sense of helplessness. The American promise of ever-increasing prosperity seemed to be a lie. People's paychecks were stagnant, but the price of groceries and essentials just kept climbing. It was a nightmare scenario that baffled experts. Economists struggled to explain this strange and painful phenomenon. The economy was stagnating, with low growth and high unemployment, yet prices were rising rapidly. This contradicted the traditional Phillips curve theory, which suggested an inverse relationship between inflation and unemployment. They needed a new word for this unprecedented economic malaise, and they coined one: stagflation. It was a toxic combination of stagnation and inflation, and there seemed to be no easy way out. For the average family, stagflation was a daily struggle. Savings accounts, once a safe haven, were now bleeding value. The interest earned was far outpaced by the rate of inflation, meaning your money was worth less each day it sat in the bank. The dream of home ownership drifted further out of reach as mortgage rates climbed. The social fabric began to fray under the economic strain. A pervasive sense of pessimism took hold. But in the midst of this widespread despair, a small group of savvy investors saw not chaos, but clarity. They understood a fundamental principle of economics. When the value of paper money is destroyed, the value of real, tangible assets endures. They began to move their wealth out of dollars and into things the government couldn't print. They sought refuge in assets that had intrinsic value, assets that had served as a store of wealth for centuries. Gold was the most obvious choice. Freed from its official peg of $35 an ounce, its price began to climb. As inflation raged and confidence in the dollar collapsed, investors flocked to the yellow metal. By the end of the decade, the price of gold had skyrocketed to an astonishing $850 an ounce. Those who had bought gold early saw their wealth multiply by more than 20 times. Silver, often called poor man's gold, experienced a similar spectacular surge. But the flight to real assets didn't stop there. Farmland became a hot commodity. As the price of food rose, the land that produced it became more valuable. Agricultural real estate values soared, creating a generation of wealthy farmers and landowners. Oil, the very source of the crisis, also became a source of immense profit for those who owned it. The smart money didn't panic or run from the chaos. Instead, they used the chaos as a signal. They understood that in an inflationary environment, the worst thing to do is hold cash. The best thing to do is to hold things. For every dollar that died in the fire of inflation, a new empire built on real assets was born. The economic pain of the 1970s couldn't last forever. The public demanded action, and in 1979, a new chairman of the Federal Reserve was appointed with a clear mandate: to slay the dragon of inflation. His name was Paul Volcker. Volcker was a towering figure, both literally and figuratively, and he knew that defeating inflation would require drastic, painful measures. He declared war on rising prices, and his weapon of choice was interest rates. He began to aggressively raise the federal funds rate, the rate at which banks lend to each other overnight. The rate climbed higher and higher, eventually peaking above an eye-watering 20% in 1981. This was shock therapy for the economy. The medicine was brutal. The high interest rates choked off borrowing and spending. Businesses that relied on debt went bankrupt. The housing and auto industries ground to a halt. Unemployment soared into the double digits, reaching levels not seen since the Great Depression. The country was plunged into a deep and painful recession. Volcker was vilified. He received death threats. Farmers protested by blockading the Federal Reserve building with their tractors. But he held his ground, convinced that this short-term pain was necessary to restore long-term stability. And he was right. Slowly but surely, the brutal medicine began to work. The high interest rates finally broke the back of inflation. By the mid-1980s, the fire that had raged for a decade was finally extinguished. Prices stabilized, and a new era of economic growth and prosperity, known as the Great Moderation, began. This new age of stability, however, was bought with years of pain and sacrifice for millions of Americans who lost their jobs and businesses. The story of the 1970s is more than just a chapter in an economics textbook. It's a powerful lesson about the nature of money and the enduring principles of wealth. It teaches us that every generation faces its own economic challenges, its own forms of inflation, whether it's the overt price hikes of the 70s or the more subtle asset price inflation we see today. But the fundamental rule never changes. When faith in paper currency falters, real value survives. History doesn't repeat itself, but it often rhymes. Understanding the lessons of the past is the key to navigating the uncertainties of the future. This is the Chronicles of Capital, exploring how money was made and how it still is. Thanks for joining us on this journey through one of the most turbulent economic decades in modern history. If you found this story insightful, be sure to hit that like button and subscribe to our channel for more deep dives into the world of finance and history. We'd love to hear your thoughts in the comments below. Did your family live through the 70s? What stories do you have? Until next time, stay curious and stay informed.